Before we dive in, this video is for educational purposes only and is not financial or tax advice. Everyone's situation is different, and for anything specific to your circumstances, please consult a qualified tax advisor. Now, let's talk about something most dividend investors discover the hard way. You buy a fund, you see a yield of 4% on the screen, and you think, great, that's what I'm getting. Then the dividends arrive and the number is smaller than you expected. What happened? Withholding tax happened. And today we are going to explain exactly what it is, where it comes from, and how to think about it as a European investor. When a fund or broker quotes a dividend yield, that number is almost always gross, before tax. Withholding tax is what a country applies to dividends paid to foreign investors, taken out at the source before the money even crosses a border. If a US company pays a dividend, the US government withholds a portion before sending the rest abroad. You never touch that withheld amount. It is gone before it reaches your broker. Let's use the United States as our main example, since it's the biggest weight in most global equity funds. The standard US withholding rate on dividends for foreign investors is 30%, but the US has tax treaties with most European countries, dropping that rate to 15%. If your country has no treaty, or your fund structure doesn't benefit from one, you could face the full 30%. Here is where it gets painful. You might pay withholding tax at source, say 15% in the US. Then your home country may also tax that same income as investment income when it arrives. That's double taxation. Many European countries have mechanisms, tax credits or exemptions, to reduce this, but they vary enormously by country, which is exactly why a local tax advisor matters. Take Germany as a concrete example. It applies a flat tax on dividends and capital gains called the Abgeltungssteuer, combined with the solidarity surcharge, about 26.375%. A German investor holding a US dividend stock could, worst case, face US withholding tax and then German domestic tax on top. This is why structure matters so much. The US is not the only country to watch. Switzerland withholds a large share of dividends paid to foreign investors. France applies its own rate. The Netherlands takes 15%, and the UK, interestingly, withholds nothing at all. Rates depend on treaties between the two countries involved. The figures here are indicative, so always verify for your own situation. Here's a concept that changes everything. Where your fund is legally based, its domicile determines which tax treaty it can use. Ireland has become the dominant hub for European ETFs largely because of its tax treaty with the US. An Irish-domiciled fund holding US stocks pays 15% withholding, the same treaty rate individual investors get, better than funds domiciled elsewhere like Luxembourg. That's why the vast majority of US equity ETFs sold to Europeans under the UCITS regulatory framework are domiciled in Ireland. When you look at ETF tickers, you'll often see ACC or DIST, accumulating or distributing. A distributing fund pays dividends out in cash. An accumulating fund reinvests them automatically. The fund pays the same withholding tax either way, but in many European countries, a distributing fund creates a taxable event on every payout, while accumulating can defer that tax until you sell, meaning more capital compounds for longer. That said, some countries have look-through rules taxing deemed dividends annually even in accumulating funds, so check your local rules. In some situations, investors can reclaim withholding tax deducted in a foreign country, especially if a treaty entitles them to a lower rate than was applied. If a country withheld 30%, but the treaty rate is 15%, you may be able to file for the difference. In practice, this is often complex and time-consuming, sometimes not worth it for smaller portfolios, but for larger holdings it can matter. A good broker will usually apply the correct treaty rate automatically, but it's worth checking your statements to confirm. Many European countries offer tax-advantaged accounts, similar in concept to ISAs in the UK or the PEA in France. These wrappers can shelter your investments from domestic income or capital gains tax, but they generally do not eliminate foreign withholding tax, which is deducted at source before the dividend even arrives. France's PEA, for example, exempts dividends and gains after 5 years, but it's restricted mostly to European equities. Global exposure inside it usually requires synthetic ETFs that don't directly own the foreign shares. Wrapper and withholding tax interact in ways that aren't always obvious. It's tempting to chase the highest headline yield, but withholding tax means after-tax yield is what really matters. A fund yielding 4% from a high withholding jurisdiction can deliver less after tax than one yielding 3% from a lower withholding jurisdiction. Here's a simplified illustration, purely to show how the maths works. A US equity fund yielding 4% facing 30% withholding with no treaty nets closer to 2.8%, with the 15% treaty rate that rises to around 3.4%. A UK equity with zero withholding passes through the full 4% before domestic tax. Fund structure and domicile can add or subtract almost a full percentage point of real return. If you own individual foreign stocks directly, withholding tax applies to each dividend, and you handle treaty rates and reclaims yourself. With an ETF, the fund handles withholding on all underlying dividends before they reach you, which is why fund domicile matters so much. For most retail investors, well-domiciled UCITS ETFs are simpler than managing individual foreign stocks across multiple jurisdictions. The most common mistake is simply not knowing withholding tax exists. The second is ignoring fund domicile. The same index can have meaningfully different after-tax yields depending on where the ETF is domiciled. Third, mixing up accumulating and distributing without understanding local tax consequences. And fourth, assuming a tax wrapper eliminates all tax drag when foreign withholding often still applies at source. Tax rules vary significantly across Europe. What applies in Germany doesn't apply in Spain or Italy, so always research your own country's rules. Let's bring it together. Foreign dividends almost always face withholding tax before they reach you, typically 15 to 30% for US dividends depending on treaty. Irish-domiciled UCITS ETFs are generally the most tax-efficient way for Europeans to access US equities. Accumulating ETFs may defer domestic tax friction, though your country's rules determine the actual benefit. And your own domestic investment tax, like Germany's 26.375%, adds another layer on top. Before you buy your next dividend ETF, ask yourself these 5 questions. Where is the fund domiciled? Is it accumulating or distributing? And what does that mean for your tax situation? Does my tax wrapper actually shelter this investment? What is the realistic after-tax yield, not just the headline number? And am I in a situation where I might be able to reclaim some withholding tax? These questions do not take long to answer, but they can make a meaningful difference to your actual returns. That's a wrap on dividend tax traps for European investors. As always, this is education, not financial or tax advice, and your situation will depend on your country of residence and personal circumstances. If you found this useful, like and subscribe so you don't miss future episodes, and check the description for a link to our free newsletter where we go deeper on topics like this. Do your own research, speak to a tax advisor for your specific situation, and we'll see you in the next one. This is the European Investor. Thank you for watching.